Hello, everyone, and welcome to our market update episode where we're looking at the month which was December 2024. And the good thing about that particular month is the end of the calendar year, so we can see what property actually did in 2024. And, you know, it wouldn't be any fun without my two co-hosts, Dave Johnston and Cate Bakos. How are we?
Happy New Year, guys. First really recording in the new year for us.
Oh, you've just blown our stand, Dave. We had all these pre-recordings all lined up.
Yeah. I'm sure we said happy.
Well, it won't be the first one our listeners listen to, but
yeah, we like to keep the market updates fresh, don't we?
We do.
I don't know. I'm a year in and chronologically I still don't understand. But at the very least, we come to you today talking about the month that was December 2024. And gosh, I mean, you've probably already seen it in the media because nationally, falls. The market's tanking, guys. I don't know if you've read the newspaper, but we lost 0.1%. So it's all over. We need to pack up shop. We need to shut down our businesses and find a safe place to let the storm go over. What do you make of that?
Yeah, doom and gloom. Look, there are markets within markets. Some of us didn't fare so well. Melbourne was the leader on that negative leaderboard, but we also have to factor in December slowdowns. You know, we get a lot of listings banking up towards the end of the year as buyers are opting out and getting into Christmas, and it's not an unusual pattern. So, you know, one, as my husband always says, one data point doesn't make a trend line.
No, exactly. Look, I think it's a function of the lag effect of interest rate rises. You know, the property market is now starting to really, across the board, feel that stress. It's also part of the reason for this is the drop in migration numbers as well over the last 6 months. But, you know, we're seeing Perth, Adelaide and Brisbane starting to move back to a semblance of normality in terms of rate growth. So, look at that. We've been following that trend for probably 6 months now, and it's going to be interesting to see where Perth, Adelaide and Brisbane finish up. You know, Perth now for the first month in a long time has had less than 1% growth. So it had 0.7% in the month of December, that down from 1.1. So annualised, that's 8.4. Adelaide dropped again down to 0.6 for the month of December. So that's annualised at 7.2. Brisbane dropped down to 0.5. So that's annualised 6%. I'm really interested to see how low those three go and if they start to move into negative territory in 2025, among other things.
Interesting. That's maybe an insight into Dave's predictions, which are coming up on a future episode of what's going to happen in 2025. And I mean, it'd be a bold call to put Perth into negative territory for 2025. But is that like a little spoiler?
Oh, look, I think it's too far. It's moving still fast enough that it might just hold positive territory. But wouldn't surprise me. I would expect it probably to have negative months in the back half of the year, maybe in the final quarter of 2026. Mm-hmm. And I think, Adelaide could, it went from sort of being an ugly duckling for quite a few years. And Pete on our podcast for probably, he was on here obviously for the first 4 or so years and would keep talking up Adelaide's prospects. And unfortunately, it only took off once he left the podcast.
And once he sold a couple, sorry.
Once he sold a couple. But I think, ugly duckling to swan. And but I think it could be in for a lengthy ugly duckling period again.
I reckon. So we might have a difference of opinion for our predictions. I'm looking forward to it.
Well, I think I'm going to make some predictions that are multi-year this year. I've been thinking about it a little bit. And that is one of those with Adelaide. I think we might be looking at 3 to 5 years ahead and its median value will still be around the level it's at now.
Wow. Okay. Well, keep your powder dry as best you can, Dave. I mean, I am very excited, but we do need to put that episode together. But speaking of negative months, we saw everywhere negative except our big three, and then one little wild card, Darwin, which is not a wild card if you look at the property forums, because a lot of people saying, what's the next Perth? And, you know, the logic doesn't seem to be terribly more sophisticated than, well, Darwin hasn't had a run for a while, so maybe it's its turn. Like, that's kind of how property markets work. Maybe they do. I don't know. What do you guys think?
I think we should do an ep on Darwin and get as much data as we can, get some anecdotal evidence from some Territorians, and just make sure that we cover it as broadly as we can, but as in detail as we can as well, because we covered Perth. We got a little bit of pushback there, but I think it'd be good to delve into it, because I look at Darwin as an experienced investor who hasn't invested in the Northern Territory. There's some definite pros for Darwin, but I'm nervous about volatility. So I think that we should do a full ep and work out how much truth there is to that fear of mine.
Dave, you must have a cousin or an uncle as the mayor of Darwin. Sure, you can touch.
Look, I think Northern Territory is the only state or territory that my extensive family doesn't cover. But, you know, I did get some extensive data from very well-connected family members in Perth, which I didn't really explain very well when we did that episode. But, I think it would be great to do a deep dive into Darwin, and that sounds like one to do. There are. I was trying to find. I think there was another sort of little price signal from Darwin that I saw as I was reviewing this month's numbers, but I just can't find it as we speak. So, yeah.
I noticed a couple of interesting little pieces of data here. Firstly, we talked about the national figure, quarterly and monthly, being down 0.1%. Nobody talked about combined regions. The regions are up for the quarter 1%, and for the month 0.2%. So we've had quite a while now where regions overall have outperformed the combined capitals, and that shouldn't be a shock.
They're up 0.2%, just to clarify.
Right. Yeah, up 0.2% for the month and up 1% for the quarter.
Yeah.
And annually, combined regions did 6% and combined capitals did 4.5%. Now, the other thing that I noticed was Perth and Adelaide's median values. They're almost line ball.
Yeah. That's a bit of a surprise. I mean, before Perth's run, it was the second lowest median after Darwin. So, that tells a bit of a story there. Darwin's median house price at the moment is $496,000, which is just seems like an era a couple of years ago.
That's right.
Perth and Adelaide both over 800, beating Melbourne by quite some margin as well.
Yeah, so Melbourne's sixth on the median value across all dwellings. Now, I do keep track of their houses and units as well. So it is only fourth in the houses, and it's third in units. But as we've talked about, the reason it's sixth is because Melbourne has a higher percentage of units than houses compared to a number of those other capital cities. But there's been no significant changes, hasn't there, throughout the year? And actually, Perth overtook Adelaide for unit median just in this month, and it's also catching Melbourne, which is only 18,000 above the median for Perth units now. So it certainly has been a year of Melbourne slipping, hasn't it, and becoming much more affordable relative to these other capital cities.
Yeah, and I think that's fair. Static to slipping is how I'd describe Melbourne in the face of pretty much everything else doing really well. And when I talked about Darwin's volatility, when we look at the median value span over the rises and falls of that market, your equity losses, if you were to sell after paying a premium at the peak, would be really considerable. When I look at Melbourne, we certainly can point to a lot of investors that if they've sold over the last couple of years after having bought at the peak, they would have had losses too, but nowhere near the same magnitude.
Ouch. Taking up your point, Cate, about the regionals doing better than the capitals, look, compare the chart below where we're looking at the quartiles. So if you look at the performance for 2024, Brisbane, Adelaide and Perth, it's the lowest 25% of values that have really done the heavy lifting in terms of the price appreciation.
For every single state and territory except the ACT, and it's marginal there. Their quartiles are all reasonably similar, but every other single state and territory has had the lowest quartile performing stronger than the other two.
So I made the comment about 2023-24 being about affordable markets, and I think that's really because of the interest rate rises that we've had. And you can overlay that with the difference between the capitals and the regions in median value. So combined regions at 657 and combined capitals at 896. I think the regions are more affordable and they're attracting more investment, and that lower quartile is where the growth is, because I think there's just more competition, more people playing in that space. What do you think, Dave?
Yeah, 100%. And the numbers back that up, Mike. So actually I have the numbers here in terms of across the country, the bottom quartile increased in value 9.8%, whereas the upper quartile only increased in value by 1.5%. So that's a significant disparity between those two outcomes, isn't it? And, with affordability hitting, people have gravitated to that bottom quartile across our capital cities, and that's got a 10% return on average. And obviously there's some gravitation to regions as well.
There's a few things driving that. Obviously affordability is a big one, but when we break it down, we've had an increase in first home buyers, particularly in Vic. We've also had an increase in investor activity, but investors are obviously hamstrung with the borrowing capacity, and a lot of them are reliant on gross rental yield, whether it's because they want to have a property that's not so much of a cash flow burden, or they want to build a portfolio and they know that they need to have more cash flow driven properties, or it might just be that they're dunking their toe in the water and it's all about being comfortable.
Yeah.
Interesting.
I was just going to say, actually 5 of the 8 capitals recorded a decline in values for the back half of the year. So it was only Brisbane.
I was just looking at that graph and I was going to make the comment, if you look at the trend line for the rolling 3-month change, it's seemingly across the board except for Hobart, you would say that we are past the peak for those markets that have appreciated. Everything is on the down slide.
Yeah, absolutely. And that's where we might be seeing that changing of the guard across 2025, of the top 3 falling down, the others starting to rise up again. And, even if you just look at the differential from the onset of COVID across the capital cities, you've sort of got almost 3 tiers. I mean, Melbourne is only up 8% since the onset of COVID. Now, there was that period where everyone remembers prices went crazy, so to speak, so Melbourne's only up 8% because it's fallen again and flatlined. Then you've got sort of the little bracket of Darwin, Hobart and Sydney, which are up 25 to 28%. And Perth, Brisbane and Adelaide are up 68 to 77%. So it suggests there's some room to move and elasticity in there, doesn't it, for Melbourne, Hobart, Darwin and Sydney.
If mean reversion is your theory, yes.
Yeah. If you expect over that period of time there to be a level of mean reversion. Now, always with mean reversion, it can be, it depends on the date you start and the date you finish, because markets can be at the beginning or the end of runs when you look at, a 10-year, what have cities done for the last 10 years or the last 5 years, or in this point, it's from the onset of COVID. So you still should factor in what was happening prior to the onset of COVID. And from my recollection, Melbourne and Sydney were going quite well with low double-digit growth. So that needs to be considered. But, I think over the long run you do, unless Melbourne, the pants has absolutely, fallen out of Melbourne for the long term, which, hopefully isn't the case.
We can look at Perth and Perth's terrible performance over a very long period. And I'm sure that, Perth owners were looking at mean reversion saying, when is it our turn? But there were some other underlying issues and drivers there that precluded that market from bouncing back in quick timing. So we can't just assume. I think that mean reversion is a fascinating topic, but Melbourne has had its share of issues, and in my opinion, there'll be a combination of things that will bring us back to life. And I wouldn't like to think that we have to wait until November next year for our state election. I'd like to think things will gear up sooner, but that's certainly one driver that will change sentiment. I do think that an interest rate cut will bring a strong focus back here, but wait and see.
Got some data on predictions for when we're going to see those as well, so share those in a moment. I've actually got in my head to do an episode on mean reversion. I don't know if it's awesome. Going to work as an entertainment piece, but
I think it'd be a great episode.
It's up there with tax, Mike.
Yeah,
I think that's a I think it's a good one because people love to look at. I think some of our most listened to episodes of where we've gone back in history and look at what prices have done or what markets have done over a period of time. And, mean reversion is a version of that. And although it's just one data point and you should never just make decisions off one data point or make assumptions off one data point, obviously you've got to piece various data points together before you make a considered decision, but it certainly is a very interesting one. And I think, if you look at the history of our capital cities, there certainly is a history of mean reversion.
The issue that I've got with mean reversion is that as a principle, it makes perfect sense. Let's say we've got a random number generator between 1 and 10 and we keep hitting it, and then we get the average over time, and let's say it's underperforming the average for a period. Well, it makes sense that it has to sort of pull its way back because everything is static, but cities are dynamic. People will come in, people will leave, you get natural increases, you've got economic stimulus, you've got jobs, you've got
changing governments.
Yeah, exactly. You got debt levels, you got stamp duty.
You got the underlying economy.
Yeah, these are all dynamic things that kind of throw the essence of mean reversion kind of into disarray because we're not comparing like for like anymore.
Well, they can. They have the potential to.
It can, yes. Anyway, we'll leave that for the episode.
Because one of the big factors with our capital cities is the population numbers.
Yes.
And then that tends to drive the underlying economic activity, the jobs, the companies, the incomes, which then obviously drive property prices. And so, I guess for a fair period of time, Melbourne and Sydney are outliers in terms of population. Then you've got your next tier of cities. So that sort of is one factor that does pull towards a mean reversion for our capital cities. And because we are a relatively small country population-wise. And,
to support that, the most commonly used ratio between cities is Melbourne versus Sydney. It's interesting now that we're correlating Melbourne versus Adelaide, Melbourne versus Perth, Melbourne
Brisbane,
versus everything else that's
Canberra.
performing. That's right. But we've often used the Melbourne-Sydney comparison, and it is a little more smoothed out because you've got, as you said, Dave, larger cities, larger populations, larger arrays of jobs and industries and head offices and manufacturers and all of those things. So I think it'll be a cracking episode. That's what I think.
Yeah.
All right. Well, if you want to stop it, then jump in the comments, get on the Facebook page or the website, and you might have a chance. Otherwise, I'm galloping away to what will essentially be 40 to 50 minutes of extreme boredom if it's not up your alley.
Come on, don't say that about your episodes or ours. That's going to be a ripping episode.
His true self-deprecating style.
Yeah.
Moving on to rents, right?
Yes, please. Let's talk about rents. And And one thing that stands out for me is the annual change in rents for houses or units. Nobody is in double digits now. Maybe bad news for investors, but good news for renters. And I think good news for Australia, because when we're at double digit rental growth, we get politicians getting very nervous and saying all sorts of uneducated things that would exacerbate the problems like rent caps and all sorts of things like that.
Yeah, that has slowed down, hasn't it? I don't know whether it's just, holiday news, other stuff's more gripping, or genuinely that spotlight has shifted or it's died down a little bit. But it's
Fingers crossed, hey?
Yeah.
Property
But
prices
8%,
are, flatlining.
it's still strong though.
It's
As a
strong
property
over a
investor,
year. Yeah.
we thought, okay, that huge surge in rental growth has now subsided, because as an investor, you're listening to your property manager, you're mindful of not losing a good tenant, you're worried about all kinds of things that, if you're taking someone's advice to put the rent up, there are things that people push back on. And then, of course, you've got to make sure your property is tip top. If you've got a great tenant who's saying, hang on a second, this 15% rent rise, what am I getting for it? And even now, we've assumed that that's behind us, but we've had property managers still saying, no, you do have to take it up to this level, otherwise you're behind market rent. And so for any investor out there, I don't think any of them are talking about the rental growth they've had, even currently, 8%, 7%, 5%, whatever. It's still above.
Can they? Really?
It's
Yeah,
massive
that's right.
historically.
It's still
historically.
above CPI.
Yeah. I think the thing is we're now looking at numbers that on a monthly basis versus over the whole 12 months that are actually below average historical trends. So we only increased by 0.1% in December, and that's, been a significant slowdown. Even if you analyse that's 1.2%, which is well below wage growth. So, that's the smallest December quarter rise in rents since 2018.
Yeah.
It's a good start.
Yeah, so
Now,
that's
what's
6
happening
years.
with Hobart, though? Everything is slowing down except Hobart. It's really sped up. I've got a couple of theories there, and I think I've always said this, but it is about the weather, and it's also about contracts. So you've got a lot of contract jobs down there, particularly around the city, and you'll often see activity in December, January, February, because people are trying to secure their home once they've got a contract down there, and they will forward plan.
That was my wild card for 2024, that Hobart would turn around and post some growth. And I think, like always,
Bit of mean reversion, hey, Mike.
Yeah, a bit of mean reversion, even after I smashed it.
Yeah.
But everything sort of stayed the same, I think, in Hobart. I'm not aware of any major shocks down there, apart from the Sydney to Hobart, which was absolutely horrific this year.
Yeah. Well, look, rents fell in 2023 for Hobart. I've got those numbers here just in my own data prep. So they fell 3.6% in 2023. So, yeah, it was right for a bit of change there.
Yeah, after we did our reno, yeah.
Is that good timing?
No, it was all right. 3.6%. Let's keep it in perspective. Hobart's been a really good performer.
So we're talking about gross national rental yields now at 3.7, and there's almost a 1% spread between capitals and regionals, with regionals leading the charge at 4.37, as they typically always do. But that just kind of says to me that every investment property now is negatively geared if you're on anything higher than an 80% LVR, which most investors would be. So it'll be interesting to see the impact of the interest rate cuts, because it's going to take people from negative cash flow to perhaps more manageable cash flow, or those people that are sort of there or thereabouts maybe getting back to neutral. But we're still a long way from those halcyon days of the cash flow positive portfolios that almost all of us had, that had not done the majority of their purchasing in the last 12 to 24 months.
Yeah.
Yeah. So a few numbers there, and this is the unit market, but houses would probably be moving similar directions at least. So the Melbourne unit sector had a 37 basis point rise in the gross yield to 4.8%. Now that will be because units remained sort of flatlined, give or take, in price, but rents went up. So their yields up at 4.8%, whereas units in Perth fell by 71 basis points in terms of the yield. So if you're buying today, you'd be getting 0.7% less in rent relative to the value of the property. Brisbane yields fell by 54 basis points and Adelaide yields fell by 36 basis points. Again, this will be because the prices went up.
Yeah.
But it means you're getting less bang for your buck on the day you buy the property for the rent, and that is something we know investors look at, and that drives investors.
That's true. They might be looking further afield, and
Well,
it seems like maybe they already are.
Darwin jumped 47 basis points, talking about Darwin, and you can get a average yield of 7.9%. So that still might be positively geared.
I reckon that between the three of us, we know quite a few people in the space. If we all sort of like got our heads together and just sort of said, like we actually are all in on Darwin, I think we can artificially move that market.
Good on you.
Move the market, I'm sure.
Property trio.
Small enough
I
population.
love it.
Just wait till I get one first, and then we'll start talking it up. Let's talk vacancy rates because, it's interesting to see November vacancy rates in places like Melbourne at 2%, which is probably on the lower side of a balanced market. But
historically,
it's feeling much more balanced. And, Sydney 1.8%, Canberra 1.7%. Obviously, it's not been doing that well. Darwin, we've just been talking about, it's still 1.6. Compare that to Brisbane 1.1, Perth 0.6, and Adelaide 0.7. This is where I'm interested to hear your thoughts, Dave. With Adelaide having a 0.7% vacancy rate in November, and you're a bit of a downer on the whole place, which Pete would hate if he was here. Is that something that worries you, that might sort of surprise to the upside with such a tight vacancy rate in Adelaide?
Yeah, it sure does. That low vacancy rate for Adelaide is definitely a concern in terms of prices flatlining. So, obviously we need the South Australian government to build more properties as part of my picture for Adelaide flattening out over the next 3 to 5 years. Because I guess broadly, I just think the prices relative to incomes and the overall economic drivers of that city, I think, has prices very high at the moment. So
there's jobs creation in Adelaide. They've got lots of good jobs at the moment, and they are attracting people. So I think this burden is here to stay for a little while.
Yeah. I think Malinowskis, from my perspective, is a very positive, upbeat, can-do premier.
Relative of yours, Dave?
No. No doubt he's having a positive impact from what I can see, and that certainly can be. It's certainly part of the picture that can push up property prices.
What's really interesting is for contrasting last year, same time, and then just October 2024 to November 2024, we have not had tightening vacancies in any single state or any single capital city. Some of them have held, but all of them have loosened a little bit. And dare I say it, that's one key reason why we've had less news headlines as well.
Yeah. Interesting to keep an eye on that, although with the data on non-refinance investor lending at over 36%, I think. Don't quote me on that, but it's there or thereabouts. I mean, that's got to feed into it as well. Cate, let's talk about sales and listings. As probably the member of the team that is more closely connected to the transaction itself, what is of interest to you, and what are you seeing in your little slice of paradise?
Look, sales have been under the 5-year average for the last 2.5 years. And all when you look at the pattern as well, it's very cyclic. We know that we have a drop in sales activity in December, January. So that's not a great shock, other than for me to say that it's only just recently risen above the 5-year average. So we had an uptick in sales activity.
Listings or sales?
Sales activity. But it's listings that I get really excited about, because they tend to filter through into our market dynamics more so, because sales are only a reflection of listings, but it's the surge of listings, the availability of listings that tells a really good story, and particularly when we look at new listings, all listings, and old listings. So if I have a look at listings, really we can't complain for the second half of last year. Actually, for all of last year, we had decent listing volumes. They were at or above the 5-year average. There wasn't really a moment in last year's history when new listings drifted below the 5-year average. And when we have a look at all listings, we can see that they were quite a way below the 5-year average. And in fact, this year, last year, and 2022, so when I say this year, 2024, 2023, and 2022 were all quite away below the previous 5-year average, but it did start to tighten up, which means that we had enough new listings to raise that all listings figure. And really, 2024 was the year of decent listings, let's be honest. And as someone who was out there, certainly experienced that. And for Melburnians and for Victorians, really, the low-hanging fruit was pretty good quality fruit. The toughest part was getting buyers to get enthused about buying in these markets, but we had some quality properties, A-grade properties, where competition was still there, but it was less. I didn't have many crazy sales last year where I would have talked about it or expected to see something in the paper, because we had a lot of, underwhelming or, to be expected results, but we had some quality property. So that's probably how I'd describe listings for 2024.
You're very good at those acronyms, Cate. I think my favourite one of yours, which was ridiculous, really, I think was FOBOBO. It was like fear of buying before a better option or something.
Yeah,
it seems like there's a fear of buying when there's no competition. It's
That's
like,
right.
seeing a restaurant with a line around the street. You're convinced that there must be some
it
good
must be
material
good.
there. But,
Yeah.
they could also own the place next door and nobody's there. It's like, something must be wrong with it. I
Yeah.
guess that's the similar thing with
It is.
Melbourne,
People
right?
love social proof. I've
Yeah.
seen people at auctions. I had a really interesting one actually late last year. I digress, and I know the clock's ticking, but it's a goodie. I had every bit of intel from the agents that I had 3 competing buyers. And he even said to me, I think these were his exact words, you're going to have to get your people to dig deep, Cate, because we've got some strong interest. And I even got a bit of a bio on the other buyers, so I kind of knew what to expect, who to expect. Anyway, I get there and I see the slightly older couple. I'm like, oh yeah, they must be the ones. And I went over to the agent and said, are they the ones you're talking about? Yep, they're right on it. They've had a building inspection. Anyway, I was ready for competition and I bought the property and they didn't bid. And
Right.
it was a really strange auction. It became ours pretty much towards the very end. They put it on the market and then there were no further bids. So those other people would have to be scratching their head thinking, why didn't we bid? But that was 2024, certainly in Melbourne anyway.
Interesting. I suppose if no one else is going to bid, even I could be a buyer's advocate. Let's talk about...
I'll take you up on that.
No, thank you. Although I do love lattes and Range Rovers, which is normally how I tease you about your job being. Consumer sentiment. Let's get into that. We're running out of time. Dave, what do you got for us?
Well, I was before we get there, I was just going to say another signal for our listeners in terms of a change across 2024 is the days on market. So it held pretty steady through much of 2024 at 28 days on average across the country, but it's trended higher in the December quarter up to 33 days. So obviously, that's a pretty clear sign of a weakening market, which we've seen come out in the numbers. Now,
but it's a December thing too, Dave.
That's over the quarter.
Yeah, fair call.
So compared to this time last year, so just comparing the same dates, periods of time, selling times have increased in Sydney by 5 days, Melbourne by 7 days, Brisbane 5 days, Perth 3. Hobart's up 14 days longer on market. So, that's just another little, I guess, data point telling us that the market's quite a bit weaker than it was a year ago.
Yeah.
Could be my 2026 wild card if it keeps going like that. Sentiment, Cate.
Wow, this chart changed, didn't it? I looked at that percentage year on year, and I thought, wow, that's significant. But time to buy a dwelling, that was noteworthy for the month. Family finances versus a year ago, down 7.8% for the month. That's an interesting one. But when we look at the annualised data here, it really is interest rate expectations that top the pops. So as Westpac's press release said, the consumer mood has soured for 2 months in a row and it remains on the pessimistic side. However, consumers expect things to continue to improve from here. So there's definitely a positive feeling, a sense of interest rate cuts filtering through and easing the cost of living pressure and also the outlook for the housing market.
Yeah, and we're seeing that sort of directional change with time to buy a dwelling index pushing up towards 100, with more people feeling like, now is becoming a good time to buy a dwelling, whereas house price expectations in terms of what we expect prices to do falling. So
I didn't forget the toys index, time to buy a major household item. That was up 1.8% for the month and 16.4% for the year. So what does that tell us? Are people looking at instant gratification by, buying themselves toys or things for the house? It doesn't signal to me that there's large-scale panic, because they're the things typically that you'd cut back on.
It signals to me that people buying Range Rovers and going to Bali, which again seems like a personal attack on you having a Range Rover and just come back from Bali, but it wasn't on purpose. It just says that the people doing that are going to make inflation even stickier. We got to get this thing going down. Stop spending money, people.
True.
That's a baby boomers, Mike.
It is they almost certainly don't listen to this show, so we'll give them a toweling. Knock it off. Just because you don't have a home loan anymore and interest rates make no difference to you. In fact, you want them higher because you want 20% return in the bank if you can get it.
They've worked hard.
My parents had a great time in Bali, thanks very much. And it wasn't a total relax. You know that it was a bit of a ring-leading expedition, but I had a great time. Thanks for asking.
I think I'm going to end up getting hate mail for toxic masculinity or bullying you or something, Cate. So I'll soften it a little
That's
bit.
back in trend.
All right, they all know
toxic masculinity, Mike.
I know.
Now Trump's won.
Yeah, and speaking of Trump,
no more DEI.
We're not allowed to talk about Trump. Fair enough.
Geopolitics, we've got to keep our thoughts to ourselves.
I was watching Alan Kohler, or Kohler Senior, because the young fella's
one person gave
kicking
us that
some goals.
feedback.
Yeah.
We'd listened to our episodes for months.
Yeah, hopefully. The Australian dollar is tanking on the back of the appreciating US dollar, which is a bit of a concern because
it's overshadowing our hopes for a rate cut, isn't it?
Yes.
It's putting some downward pressure on it, but yeah.
What we know,
the bond bandits are still betting around 75%, somewhere around there. But
the American dollar is not the only currency in the world either. If we think about the impact of, if we have a look at our rates against other nations, it's not all bad news.
No, they're generally also having the same impact against the US dollar. As I've read a number of times, the RBA factors in a basket of currencies when it looks at this, and ours has been holding reasonably steady, but obviously the US dollar is an outlier. But so it can have an impact.
Which is probably a good segue to the rate tracker chart, isn't it, Mike?
Please, yes. You're mucking in and helping me regain control. I'm going to abandon every other data point.
Dave's gone rogue this morning.
What did I go rogue on?
Joking around.
Just sharing data points.
Quality stuff, Dave, but you're making me work for it as host today.
Someone's got to do their own research.
Yeah.
So I sent the notes through late. Sorry about that.
Yeah. Well,
So
thankfully,
this,
I do my own research as well.
so the ASX rate indicator, obviously, it's on a per trading day basis, not necessarily on a picking when it's going to be a cut at which meeting. But if
Well,
we
that's
look at,
what it is actually. It's the 30-day interbank cash rate target implied expectation of change is for the next meeting. So this line is specifically about the expectation that we'll have a cut in February.
yeah, my point was just that the dates are basically just how it's moving over time in anticipation
Yeah.
for that next one. So 30th of December, we had a 67% consensus on interest rate cuts in that what will be the February meeting, right? That's
Yeah.
the
Yeah.
first one for the year.
Yeah.
And peaking at 78% on the 9th and 10th of January and back to 73. So another way of putting that, more than 2/3 of economists agree that we will get a rate cut at the first opportunity. Thoughts?
Yeah, well, I think I just said around 75%, so close to three quarters. I don't know if that's economists though, is it? I think that's actually bond traders, is it not? But I might be mistaken. Yeah, I look, the jungle drums are beating that it's a 75% chance, give or take, that we'll get a rate cut in February. Um, and a big part of the adjustment in that is because of the change structure to the RBA board for the first time, and there's some people who have verbally spoken about believing that rates should have already fallen, who are now decision makers, new decision makers in that February meeting. And so then the people who don't want the rates to fall are writing articles saying it'll be absolutely politicized if rates fall in February and they shouldn't fall. So that's sort of the banter that's going on in the economics world currently, which most people pay no attention to, but bond traders do.
And I think the latest CPI print is pointing to the fact that we've got to do it soon. So whether
Yeah,
it's
fell
February or
again.
not, yeah,
I
it
I
seems
might get into the 2 to 3% as per my prediction by the time the December month hits.
interesting. Well,
We'll
Dave,
see.
I think we need to leave you to go and finalise these predictions because that's coming up on our next recording. And I'll give you guys an opportunity to give your summarising thoughts rather than nuggets today. Cate?
Just quickly, the portion of new lending for investment housing is significantly above historical levels. We're at 38.3%. I think that is a bit of a hallmark of 2025, and it's interesting that we've had higher rates and the cost of living and all of the things that can plague investors making a decision to move forward, yet they are moving forward. And even anecdotally here in Melbourne, I'm getting a lot of interstate investor inquiry. We've had the wealth effect kick in. People have equity to spend. And I think that will have a broad impact on our markets this year.
Interesting. Dave?
Yeah, look, I agree with that. I just think those changes will materially play out in 2026, but we'll talk about that in our predictions episode. What I found is often there's different companies that record property values changes. We always talk about core logic, and it's got probably the most complex sort of equation algorithm way of figuring out these numbers. Sometimes when you look at the simpler indexes, I think it can pick up the changes sooner because they are less complex statistical measurements. So what I found interesting was, for example, PropTrack's index. It actually had prices falling in Brisbane and Adelaide in the month of December. So they both were in negative territory. And Perth, it had only increasing at 0.39%. Now, if you look at their annualized growth numbers, they're very similar to Core Logic. I know December can be slightly different because there's a bit less activity. The month, generally obviously finishes earlier, etc. But that says to me there's a fairly good chance, and it's just one piece of data, and it can't necessarily be relied on. But I just found that quite interesting because annually it had Brisbane up 11, Adelaide up 13, Perth up 17, very similar to Core Logic. But just for December, Brisbane and Adelaide had already had in negative territory, and Perth only slightly above zero growth.
Interesting. Well, I'm keenly interested to see how that feeds into your 2025 predictions, Dave. So I will leave both of you there to consider what you want to put forward, because we live or die by the sword in 12 months' time. But I'm absolutely looking forward to that. But thank you for helping me to analyse the year that was and the December figures, and we'll see you next week.
See you guys.
Thanks, guys.